In the following video, we're working through E31. It says James starts a business as a sole trader on the 1st of February 2017, known as The Pop, providing balloon decorations for parties. Transactions for February as follows. He invests 7,000 Rand cash into the business, deposit into the business bank account. They give us the transactions 1 to 11. They ask us to record the above transactions in the accounting equation and then prepare the three statements, the three financial statements. So we start with the first transaction. I've drafted my accounting equation according to the specifications provided. So I have assets, effect, and the account. Owner's equity, capital, income, drawings, and expenses, and liabilities, the effect, and the account. So let's read the first transaction. He receives 7,000 Rand. He invests 7,000 Rand cash into the business. So we know transaction 1. He provides money to the business. So it's plus 7,000, and the account involved would be bank. This will go under capital as it's a contribution by the owner. So we say plus 7,000. Next transaction. The top borrows 3,000 Rand from James' uncle, and the interest is 4% per annum payable every 6 months. So we borrowed money. That's increasing the bank account. So we got our bank account under assets. We say increase of 3,000 Rand. Just need to put increase in front. The account under assets is bank. The effect into liabilities is an increase in liabilities of 3,000, and this is a loan made. Transaction 3. The business buys equipment for 2,500 and pays cash. So transaction 3, we bought equipment. So what happens to my equipment? It increases with 2,500 Rand under assets. 2,500, and that is equipment. We paid cash for this, so the bank decreases under assets with 2,500 Rand. You can see that plus 2,000 minus 2,500 gives me 0, so my accounting equation stays in balance. You can see each transaction I'm doing within the line. Transaction 4. The Pop buys supplies of balloons on credit for 1,000 Rand. So remember, we buy balloons to decorate this for parties. So we say transaction number 4. And it says we bought on credit. Right? So transaction number 4, we purchased on credit. So we know that our liabilities is involved. So we go under liabilities and increase our liabilities with 1,000 Rand, and that would be accounts payable because we purchased on credit. And then we use this balloons in providing our service. So we're not buying the balloons to sell it. We're using it to provide our service. So it would be an increase in supplies. Keep that in mind, please. When we buy to sell, we call it inventory. When we buy to use in order to provide the service, we call it supplies or consumables. The Pop provides balloons for a 21st birthday party and receives 800 Rand cash. So transaction number 8, we received 800 Rand cash. Bank account increases with 800 Rand. Let's just get that part right. And then we go to income, and our income, of course, increases with 800 Rand. That's transaction number 5. Transaction number 6. The Pop provides balloons for a graduation party on credit. So it means they owe us. So we increase our 1,000 Rand as asset, and that would be accounts receivable. We still into the service, so under income, we still have plus 1,000. Transaction 7. The customer from 6 pays us 600 Rand. So we received money. What happens to my bank account? Increases with 600 Rand. We received money from this customer, owes us 1,000 rand. So does he still owe us 1,000 rand? No. So we have to decrease his account by 600. That will be accounts receivable. Then we look at the next transaction, transaction 8. The POP pays assistant wages 200 rand in cash. We paid, so that decreases our bank account with 200 rand. Wages is an expense. So remember, look what I'm doing. I'm increasing my expenses, because the more my expenses increase, the more owner's equity decreases. Transaction number 9. The POP pays the supplier from 4. Transaction 4, 700 rand. We're making a payment. So we now, our bank is decreasing with 700. Who are we paying? From number 4, we bought balloons on credit. So we're paying our supplier. So do we still owe him the 1,000 rand? No, we owe him less. So we decrease his account by 700 minus 700. And that will be accounts payable. Then transaction 10. It says the supplies of balloons costing 300 rand were used during the period. So we've used of our supplies. So what happens to our supplies? It decreases. So we decrease supplies by 300. And when we use of an asset, what does it become? An expense. So we increase our expenses by 300. Remember, I increase my expenses under expenses. Because the more expenses increase, the more owner's equity decreases. Transaction number 11 says recognize the interest expense for February. So if it's 3,000 rand that we took out as a loan at 4% per annum, right? So we say 3,000 rand multiply by 4%. So that's how much it is for a year. But we only used 1 month. So we say divide that by 12. So it's 10 rand. So it says must recognize the expense. So we say my expenses must increase with 10 rand. And we still owe it. So that 10 rand goes into liabilities as expenses payable. Remember, we're saying we recognize the expense. Nowhere does it say that you paid the expense. So now once you've completed the accounting equation, you can now prepare your statement of profit or loss, statement of change in equity, and statement of financial position. I want you to make an attempt of this. Once you've completed your accounting equation, balance it and make sure the accounting equation balances, and then prepare the 3 financial statements.